Every day, it seems like I get asked by another entrepreneur, when will valuations get back up? Back up to the heyday of 2021. And sadly, I doubt they will reach 2021 levels for a long, long time. Sorry. But there is light at the end of the tunnel, so stay tuned, and I'll tell you why 2023 might be one of the best times to raise money from VCs. So first of all, let's talk about how did valuations get so high? Well, if we back up and we think about this from like the macroeconomic perspective, which I apologize, I studied econ and I love econ, so indulge me. We got in this situation because the Federal Reserve, the central bank essentially of the US, has been pumping money into the system for years. And what that's done is it's effectively lowered the cost of capital to essentially zero, right? For example, I refinanced my house and I'm paying something like 2% interest on my house, which is effectively like nothing. Like inflation normally is around 3%. So in a way, in real terms, I'm paying like negative 1% on my house mortgage, which is crazy, right? But that's essentially what was happening. And when that happens, that cash is so freely available, you have a lot of venture funds that will raise a lot of money. And so over the last few years, especially in the last 3 years, venture capital funds have raised record amounts of capital for their funds. Now, this is important because as there's more and more money in the system chasing fewer and fewer deals, the prices of those deals are going to go up. I mean, it's simple economics, supply and demand, right? If there's a lot of money chasing relatively few things, then the price of those things is going to go up because, everyone's competing for that same thing. And it further gets compounded even further because in venture capital, returns follow what's called the power law distribution, where essentially one company will return most of the returns for that year or that decade, right? You think about like the big examples. So Google and Facebook and Amazon and Microsoft and Apple, right? These big, huge behemoths that are worth, trillions of dollars have returned more money to investors during their time period than thousands, tens of thousands, hundreds of thousands of other businesses that have existed at that same point, particularly in the startup space. So as a venture investor, your job is effectively to find the handful of deals that matter every single year. And the reality is we haven't really cracked a nut on increasing the number of those life-changing, economy-changing businesses. There are only a handful, really, that are started every given year. And so you have tons of money chasing after relatively few deals. So when that happens, valuations go up. And that's what you saw in 2021 is valuations were hitting all-time highs. Other things that go up include terms on those rounds. And so you had founders that were having dual class shares where they had more voting rights or special voting rights than the other VCs in the deal. You had situations like FTX where they didn't even have a board, for crying out loud, or any kind of oversight or accountability, which ultimately led to their collapse. Anyways, all of these things led to record high valuations, but not just in the venture space and the private equity space, but also across the board. And for the first time in the last decade, you started to see prices really start to skyrocket as people went out and started spending this money. And so inflation started to rise incredibly fast, right? I know all of us have felt the pinch as you go to the grocery store and everything just feels way more expensive. The gas station's more expensive. Everything just feels more expensive as inflation goes up. And when that happens, the Fed has to step in to reverse things, which is kind of ironic because they're the ones that put us in this situation, but they're also the only ones that can really pull us out of it as well. And so what they're doing to cut inflation is they're raising rates. And the reason why that has an impact is because as they raise rates, what essentially they're raising is the rate at which banks can come and borrow from them, which pushes up the cost of capital for those banks. If it costs banks more money to borrow from the Fed, then they're going to pass on that increased cost to me and you. And that's why you're seeing mortgage rates increase, auto loans increase, credit card rates increase. And then there's a whole bunch of other loans like working capital loans and other things. Those rates are also increasing. As those rates increase, the cost of capital goes up and there's less capital around. And the capital that is around is seeking for even stronger and better returns. And so what happens is if you're a business, there's less money available to you, and the money that is available to you to use to grow your business is more costly. So all of those things happen, and they impact venture capital in a handful of ways. So one, there's less money to be invested in venture funds. So venture funds will inevitably, in the near term, I would anticipate, have a harder time raising money. And you're starting to see that across not just venture funds, but private equity funds, private credit funds, like pretty much every fund, right? The other thing that happens is because there's less money in the system that can be used to grow businesses, all of a sudden these businesses have to start making cuts and get to profitability if they're not there already. And you're watching the stock market say, hey, now that capital has a cost, we can't forecast these super big returns anymore. And that's why the stock market has cratered and fallen apart. And then as the stock market starts to collapse because they're seeing this future where there's not enough money to fuel growth, what that also means is that it's going to be harder to take a company public. And if you are a publicly traded company, you're a large business, you'll have less money available to you that you can use to buy businesses. What does that mean for venture capitalists? Well, it means that window or that opportunity to sell your business to a strategic or to take it public is now a lot tighter. And in the case of the IPO market, like right now, that door is shut. Like nobody is going public right now. Because if you go public, I mean, it's just a it's just a blood house out there. Like companies are just taking massive write-downs and losing, market share and valuation and all kinds of stuff. It's just rough. And so nobody wants to go public right now. So you compound all of these things. Well, it's like, okay, I can't take my company public anymore. The companies that are out there that would buy it are less likely to buy my company. And even if they did, they don't have as much money as they used to. So they're going to pay less for my business. What that then does is that all the floods all the way back because the venture capitalists still need to generate roughly the same return. They're shooting to make about 30-ish% annualized return on their investments. And so if all of a sudden my exit potential on that business gets cut from being able to sell it for $1 billion to only being able to sell it for $500 million, that means that I have to pay a lot less for that same business. Instead of paying, $60 million for it at their Series A round, maybe I can only afford to pay $30 million in order to generate the same type of return that I need to hit. So you have all of those things happening, and then it compounds because you have this broader macro impact occurring, which is as capital gets more expensive and businesses are investing less, then the economy is not going to grow or grow as quickly, and we could enter into a recession. And that just compounds and makes everything even worse because now my business doesn't have buyers or an exit opportunity that's as favorable. But on top of that, maybe there are fewer customers that have money to spend on my product, which means I'm not going to grow as fast. I'm not going to perform as well. So what that means is that if I, as a business, a startup, have just raised a huge amount of money from investors at a very high valuation, if I don't cut my burn, I'm going to burn through all that money. And now I'm going to be in a tough spot because I'm going to need more money to keep operating, or I'm going to go out of business because I'm not profitable. And those investors, if they don't want to lose all of the money they've already invested, will have to step up and invest more money. So what you're seeing is a bunch of investors are sitting on their hands right now. They're basically saying, there might be a recession, I don't know, and I need to save money for my current portfolio companies. And the last thing I want to do is invest today at a valuation, and then 3 months from now we hit a recession and valuations drop even more. And now what I thought was a great deal today ended up being not a great deal because I have to take a down round on that same company or they're going to go out of business. So a lot of VCs are sitting on their hands. And that's what's making this such a tough, challenging market. So what does all of this mean in terms of valuations? It means valuations are low and they're going to remain low until effectively we reverse this process where the cost of capital stops increasing and starts decreasing, right? So watch the Fed. If the Fed keeps increasing rates, what they're effectively doing is increasing the cost of capital every time they increase those rates. What we need them to do for this whole thing to turn around is to start decreasing the amount that they are making the increases, and then eventually, hopefully, not have any more increases and basically say, hey, we're happy with where things are at, and maybe start reducing the cost of capital and reducing rates. That's kind of what needs to happen. But the reality is these things take a long time to flesh out. And when the Fed makes a change, it can take multiple quarters for that to flow all the way through the economy. And on top of that, there's also a ton of money, insane amounts of money that have been pumped into the system over the years, over the last decade. And so it's going to take time to start pulling all of that money back out. So what I forecast happening is that we may enter a recession next year. Eventually we will enter into recovery, but my guess is that it's going to take a while for us to just slowly grow our way out of it. And because the Fed has to watch inflation very carefully, because if they let it get out of hand, it could be really detrimental. You do not want to be in a high inflationary environment. Just look at Germany after World War I, where they tried to print their way out of a depression. And their money became so worthless that people were using it. It was more valuable as fuel in their stove to keep them warm than it was to be able to actually buy product with. And they'd have like big bundles of cash. That's not the situation you want to be in. It becomes really unpredictable, and where the price of things are going to be, and uncertainty causes risk, and uncertainty end up causing recessions. So it's important that they fight inflation, but it's going to just be painful in the meantime. Okay, I did promise a silver lining, and here's the silver lining, the light at the end of the tunnel. And that is a lot of venture funds, like I mentioned at the beginning of this, raised big rounds of funding. They raised these monster funds, breaking all kinds of records. And the reality is that these funds, they're 10-year vehicles. And a lot of them raised them in the last year to 2 years. And in many cases, they haven't even started really deploying capital out of it. So think about it this way. You have a bunch of venture capitalists that have raised records amounts of money that are sitting on their hands, not investing it. And here's the thing most people don't know about venture investing and venture funds is that you get paid management fees, but many funds only get paid those management fees. And the management fees are what you use to like pay your salary and keep the lights on, those kinds of things. You only get paid management fee on the capital you've deployed into deals. And that's not all venture funds, but many are structured that way as an incentive to get the venture fund to go out and actually make investments. The problem is that, as you can probably imagine, if I'm sitting on my hands not doing deals, I'm not pulling any management fee. And even if I am pulling management fee, I've only got a short window to make investments. Investment periods for venture funds are usually in the range of 3 to 5 years. So if I raised my fund in 2021 and I didn't start making investments in 2020 because I was so worried about the macro environment and so on and so forth, I'm sitting in my hands, blah, 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 then 2023 is going to come around and I'll only have like 2 more years of my investment period. And if I'm being compensated or I'm being able to pull management fee based on assets deployed or capital I've deployed into deals, then I'm going to be highly incentivized to start deploying capital into companies. And I think what you'll see is that valuations will continue to drop into probably Q1 of next year. And then all of a sudden, like VCs will be like, I gotta deploy capital because they don't really want to give the money back. And so they'll start doing more deals and you'll see valuations plateau and hopefully even start to rise back up again. That said, I do not anticipate that they will come anywhere near where they were in 2021. And my best guess is to look at what the market looked like for valuations in probably 2016, 2017 to get a better feel for where they might possibly be in 2023. If you want an even like more conservative perspective, you could look at 2010 through 2012 as another kind of benchmark of where valuations could ultimately bottom out and stabilize at. But that said, I do think there will be more VCs coming back into market, doing deals. They got to deploy the capital. And so if that were me and I was an entrepreneur, I would cut my burn as much as I possibly can. Do the hard things, take the layoffs, whatever it takes to cut your burn, to cut how much capital you're spending every year, and drag out that runway, the amount of time you have before you need to raise your next round of capital, as long as you can, and see if you can survive until Q2 of 2023, because I think that will end up being a great time to kick off a fundraising process and raise money. If that's not your situation and you are out of cash and you have to raise now, then my recommendation is don't do a priced round. Do a convertible note, do a bridge round, do whatever you can to raise cash from your insiders and from friends, family, whoever it is, to get some more runway. Because here's the thing, the companies that can survive this next downturn will be the best positioned to ultimately thrive. I like to think about Amazon as a good example of this. Amazon was one of those few tech companies that survived the last dot-com burst. And because of that, they watched so many of their competitors go out of business. And that allowed them, in a lot of ways, to move from just selling books to selling everything and become the dominant player they are today. And I think, if you look in the Great Recession, you had similar things happen where there were great startups like Airbnb that were launched during the Great Recession because they were able to capitalize on a need that occurred in the Great Recession and ultimately end up building really great businesses. Would Airbnb be as successful today if they hadn't started in an environment where people were trying to cut costs as much as possible, i.e. stay and travel for less money, or that were trying to generate additional income from their house? Probably not, I would imagine. So there are going to be opportunities to build great businesses, and those that can survive this downturn will be really well positioned to take advantage of the new economy coming out of it. So do whatever you can to survive. Awesome. Well, I hope you enjoyed this video today, or at least that it was beneficial and helpful as you think about how to navigate the current environment, whether you're a venture capitalist, a prospective venture capitalist, an entrepreneur trying to figure out when do you raise your next round of funding. If you are a prospective venture capitalist and you're wondering how to get into the industry, check out one of my other videos where I talk about how to get into venture capital without any experience. Thanks.